In the pre-dawn darkness of January 3rd, 2026, United States Delta Force operators surrounded a heavily fortified compound in the heart of Caracas, Venezuela. Their mission was unlike any in recent American military history. They weren't there to destroy infrastructure or eliminate high-value targets. They were there to execute what would become the largest resource seizure in the modern era. By 6 a.m. local time, Venezuelan President Nicolas Maduro and his wife Celia Flores were in American custody, transported to New York to face narcoterrorism charges. But the capture of two individuals was merely the opening act of a much larger drama that would reshape global energy markets and trigger a massive flight to precious metals. What happened in those early morning hours wasn't just a military operation. It was the opening move in what analysts are now calling the $100 billion oil heist, a coordinated effort by the Trump administration to seize control of the world's largest proven petroleum reserves. Within 12 hours of Maduro's capture, silver prices had spiked 4% to 84 per ounce as global investors recognized that the fundamental architecture of international resource control had just been rewritten. The scale of what America had just claimed is staggering. Venezuela sits atop an estimated 303 billion barrels of proven oil reserves, more than Saudi Arabia, Iran, and Iraq combined. At current market prices, that represents approximately $100 billion in extractable value. And that is using conservative estimates that don't account for the technological improvements American oil companies would bring to Venezuelan production facilities. The Trump administration had effectively nationalized the largest energy prize on the planet, and global markets were scrambling to understand what this meant for everything from inflation to international law. But the $100 billion figure represents only the beginning of the story. Venezuela's oil infrastructure, while degraded after years of mismanagement under Maduro, and his predecessor, Hugo Chavez, has the potential to produce up to 4 million barrels per day when fully restored. American petroleum engineers estimate that with proper investment and technology transfer, Venezuelan production could be restored to peak levels within a decade, generating hundreds of billions in additional revenue for whoever controls the flow of that crude oil. The geopolitical implications were immediate and profound. China, which had invested an estimated $60 billion in Venezuelan energy infrastructure over the past decade, found itself suddenly locked out of one of its most important strategic partnerships. Beijing's Belt and Road Initiative had counted Venezuela as a critical node in its Latin American expansion, but American military action had severed that connection overnight. Chinese foreign ministry officials condemned the operation as economic piracy, but there was little Beijing could do to reverse what had already been accomplished. This massive shift in resource control sent shockwaves through global financial markets, with silver emerging as the primary beneficiary of what traders were calling a flight to real assets. The metal's 4% surge to $84 per ounce reflected not just traditional safe haven demand, but a growing recognition that silver had become something more fundamental, the ultimate crisis currency in an increasingly unstable world. The reasons for silver's explosive response become clearer when examining the broader implications of America's Venezuelan gambit. Unlike gold, which serves primarily as a store of value, silver functions as both a monetary metal and an industrial commodity essential to modern technology. The Trump administration's willingness to use military force to secure energy resources signaled to global investors that the era of predictable international commerce was ending. In such an environment, owning assets that couldn't be digitally manipulated or politically confiscated became paramount. Silver's industrial applications made it particularly attractive during this crisis. The metal is essential to solar panel production, electronic manufacturing, and military hardware, all sectors that would be directly affected by the kind of resource nationalism that America had just demonstrated. If the United States was willing to seize Venezuelan oil fields, investors reasoned other critical resource supplies could be disrupted at any moment. Silver, being both scarce and irreplaceable in many applications, represented insurance against supply chain chaos. The timing of the operation also amplified silver's appeal. Global silver inventories had already been depleted by months of strong industrial demand, particularly from the artificial intelligence and renewable energy sectors. The sudden injection of geopolitical risk into global markets found silver prices rising from an already elevated baseline, suggesting that the metal's fundamentals were strong enough to support sustained higher prices even if immediate tension subsided. More importantly, the Venezuelan operation represented a fundamental shift in American foreign policy that had profound implications for global monetary systems. The Trump administration had effectively demonstrated that the United States was willing to use military force to secure economic resources, regardless of international law or diplomatic consequences. This might-makes-right approach to international commerce suggested that traditional financial instruments, currencies, bonds, even bank deposits, could be frozen or confiscated by governments at any time. Silver's surge reflected investors' recognition that hard assets were becoming the only reliable store of value in a world where geopolitical risk could instantly reshape economic relationships. Unlike paper currencies or digital assets, physical silver couldn't be devalued by central bank policy or seized through cyber warfare. It represented true economic sovereignty in an increasingly uncertain global landscape. The corporate implications of the Venezuelan seizure were equally profound. Major American oil companies, ExxonMobil, Chevron, ConocoPhillips, had been locked out of Venezuelan markets for years due to sanctions and political instability. The removal of Maduro suddenly opened the possibility of massive infrastructure investment and production expansion. Industry analysts estimated that restoring Venezuelan oil production to peak levels would require at least $100 billion in capital expenditure, creating enormous opportunities for American energy companies while simultaneously generating substantial tax revenue for the U.S. Treasury. But these opportunities came with significant risks. Venezuelan oil production had been declining for decades, and the country's energy infrastructure was severely degraded. Moreover, the heavy crude oil that comprises most Venezuelan reserves requires specialized refining capabilities that are expensive to build and maintain. American companies would need to invest heavily in both extraction and processing facilities, with no guarantee that political stability would persist long enough to recoup those investments. The Venezuelan operation also highlighted the interconnected nature of modern resource markets. China's sudden loss of access to Venezuelan crude oil would force Beijing to seek alternative suppliers, potentially driving up global energy prices and creating inflationary pressures throughout the world economy. This dynamic created additional demand for silver as an inflation hedge, contributing to the metal's 4% surge in the immediate aftermath of the operation. Furthermore, the operation demonstrated the Trump administration's willingness to weaponize America's military superiority to achieve economic objectives. This represented a dramatic departure from traditional diplomatic approaches to resource conflicts and suggested that other nations with valuable commodities might face similar pressure. Countries rich in lithium, rare earth elements, or other strategic materials suddenly found themselves reconsidering their relationships with both the United States and its competitors. The implications extended beyond energy markets into the realm of international finance. The Venezuelan operation effectively demonstrated that the United States was prepared to use force to maintain its economic dominance, even if that meant violating traditional concepts of national sovereignty. This had profound implications for the global monetary system, which depends on international cooperation and respect for legal frameworks. Silver's role as the ultimate crisis currency became more apparent as investors recognized that traditional safe havens, government bonds, bank deposits, even cash holdings, could be subject to political manipulation in ways that physical commodities could not. Central banks could print more currency. Governments could freeze assets, but no authority could simply create more silver out of thin air. The metal's industrial applications provided an additional layer of security. Even if silver's monetary premium disappeared, industrial demand from electronics, solar panels, and medical applications would provide a fundamental floor for prices. This dual nature, monetary metal and industrial commodity, made silver uniquely attractive during a crisis that threatened both financial stability and supply chain security. The broader implications of the Venezuelan operation were still unfolding as silver prices consolidated near their post-operation highs. American control of Venezuelan oil reserves would fundamentally alter global energy markets, potentially reducing U.S. dependence on Middle Eastern suppliers, while increasing pressure on OPEC to maintain market share. These shifts would have cascading effects throughout the global economy, creating both opportunities and risks that were difficult to predict. What seemed certain was that the era of predictable international commerce was ending. The Trump administration's willingness to use military force to secure economic resources represented a return to a more primitive form of international relations, where military strength determined economic outcomes. In such an environment, owning assets that couldn't be confiscated or manipulated by governments became essential for preserving wealth. Silver's surge to 84 per ounce in the immediate aftermath of the Venezuelan operation was just the beginning of what analysts expected to be a sustained revaluation of hard assets relative to paper claims. The metal's unique combination of monetary heritage and industrial necessity positioned it as the ideal hedge against a world where geopolitical risk could instantly reshape economic relationships. The $100 billion oil heist had accomplished more than just transferring Venezuelan resources to American control. It had fundamentally altered the risk calculus that governed global investment decisions. In a world where military force could determine resource ownership, precious metals weren't just investment alternatives. They were essential insurance against the kind of systemic disruption that the Venezuelan operation represented. As silver prices stabilized above $84 per ounce, market participants were already beginning to price in the possibility of additional resource seizures. If the United States was willing to capture Venezuelan oil fields, what other strategic resources might be subject to similar treatment? The answer to that question would determine whether silver's surge represented a temporary crisis premium or the beginning of a permanent repricing of hard assets in an increasingly unstable world. The transformation of silver from industrial commodity to ultimate crisis currency was complete. In just one morning, American military action had validated the thesis that physical assets were becoming the only reliable stores of value in a global system where economic relationships could be rewritten by force. The 100 billion Venezuelan oil heist hadn't just enriched America, it had made silver the currency of choice for anyone seeking to preserve wealth in an unpredictable world. But the full implications of this seismic shift were only beginning to emerge as global markets processed the scope of what had transpired. The Venezuelan operation represented more than resource theft. It constituted a fundamental challenge to the post-World War II international order that had governed global commerce for 8 decades. The Bretton Woods system, modified and updated through successive iterations, had always relied on the assumption that sovereign nations controlled their own resources. That assumption had just been shattered by American military force. The ripple effects extended far beyond energy markets into the realm of international banking and finance. Major global banks that had exposure to Venezuelan debt suddenly found themselves holding worthless paper backed by assets now controlled by the United States government. Credit default swaps on Venezuelan sovereign debt triggered immediately, creating cascading losses throughout the international financial system. But more importantly, the operation raised fundamental questions about the security of any financial instrument backed by natural resources. Silver's continued strength above 84 per ounce reflected investors' growing recognition that traditional financial assets, stocks, bonds, bank deposits, were vulnerable to the kind of overnight expropriation that had just occurred in Venezuela. Physical commodities, by contrast, couldn't be digitally transferred or legally confiscated without physical possession. This created a new hierarchy of asset safety, with precious metals at the apex. The technical aspects of silver's price action also revealed important structural changes in global markets. The metal's 4% surge had occurred on massive volume, suggesting that large institutional investors were rotating capital into physical assets rather than just engaging in short-term speculation. Major pension funds and sovereign wealth funds, particularly from nations that might themselves face American pressure, were reportedly increasing their precious metals allocations significantly. Moreover, the character of silver buying had shifted dramatically. Traditional safe haven purchases typically involved gold, with silver following as a secondary beneficiary. But the Venezuelan crisis had highlighted silver's unique dual nature as both a monetary metal and an industrial necessity. This combination made it particularly attractive to institutional investors who needed to hedge against both financial instability and supply chain disruption. The industrial implications of America's Venezuelan gambit created additional layers of complexity for global silver demand. The operation had demonstrated that resource nationalism was becoming a legitimate tool of statecraft, suggesting that other critical materials could be subject to similar disruption. Electronics manufacturers, solar panel producers, and automotive companies suddenly found themselves reconsidering supply chain strategies that had prioritized cost efficiency over security. This shift towards strategic stockpiling created a fundamental change in silver market dynamics. Industrial users who had previously operated on just-in-time inventory systems began building buffer stocks of critical materials, including silver. This was not speculative buying. It was a survival strategy for companies that could not afford production interruptions caused by geopolitical turmoil. The automotive industry provided a compelling example of this behavioral shift. Electric vehicle manufacturers require substantial quantities of silver for battery systems and electronic components. The Venezuelan operation had demonstrated that even seemingly stable supply chains could be disrupted by military action. Major automakers reportedly began negotiating long-term silver supply contracts at fixed prices, effectively removing significant quantities of metal from the spot market and providing additional support for prices. Similar dynamics were emerging in the renewable energy sector, where silver's role in solar panel production made it indispensable for the global transition to clean energy. The Biden administration's climate initiatives had already created substantial silver demand, but the Venezuelan operation added a security premium to that demand. Solar installation companies and panel manufacturers began treating silver as a strategic material rather than just an input cost, leading to substantial inventory buildups. The military applications of silver created another dimension of demand that market participants were only beginning to understand. Modern weapon systems rely heavily on silver-based electronics for guidance, communication, and targeting functions. The Venezuelan operation had required extensive use of precision-guided munitions and electronic warfare systems, all of which consumed significant quantities of silver. If the United States was preparing for additional resource extraction operations, military silver demand could increase substantially. More broadly, the operation had validated the concept of hard power economics, the idea that military strength could be used to secure economic resources directly rather than through traditional diplomatic or commercial channels. This represented a fundamental shift away from the globalized free trade model that had dominated international commerce since the end of the Cold War. In a world where military force determined resource allocation, owning physical assets became essential for economic security. The implications for central banking were particularly profound. Central banks had spent decades building foreign exchange reserves denominated in dollars, euros, and other major currencies. But the Venezuelan operation demonstrated that these reserves could be frozen or confiscated by the issuing governments if political relationships deteriorated. Physical precious metals, by contrast, couldn't be subject to such manipulation. This realization was driving a quiet revolution in central bank reserve management. Countries that had potential conflicts with the United States, China, Russia, Iran, were reportedly accelerating their gold and silver accumulation programs. Even traditional American allies were reconsidering the wisdom of holding all their reserves in dollar-denominated assets that could theoretically be frozen in times of crisis. The Venezuelan operation had also highlighted the vulnerability of the global financial system to sudden shifts in resource control. International banks that had financed Venezuelan energy projects found themselves holding worthless collateral overnight. Insurance companies that had provided political risk coverage discovered that their policies were inadequate to handle outright military seizure of assets. The entire apparatus of international finance was being stress-tested by America's willingness to use force for economic gain. Silver's emergence as the ultimate crisis currency reflected these broader systemic vulnerabilities. Unlike fiat currencies, which could be devalued by government policy, or digital assets, which could be hacked or regulated out of existence, physical silver represented true economic autonomy. It couldn't be printed, hacked, frozen, or confiscated without physical force. In an increasingly unstable world, these characteristics were becoming invaluable. The price action in precious metals markets also revealed important information about investor psychology during systemic crises. Gold had certainly benefited from safe haven demand, rising approximately 2% in the immediate aftermath of the Venezuelan operation. But silver's 4% surge suggested that investors were prioritizing assets with both monetary and industrial value over pure store value plays. This preference made economic sense when analyzed in the context of the broader crisis. If the world was entering an era of resource nationalism and supply chain disruption, owning materials that were essential to industrial production provided additional security beyond mere wealth preservation. Silver's role in electronics, solar panels, medical devices, and military systems made it virtually irreplaceable in modern technological society. The Venezuelan operation had created a new investment paradigm where traditional diversification strategies were insufficient to manage geopolitical risk. Owning stocks, bonds, and real estate in multiple countries provided little protection against the kind of systematic disruption that military resource seizure represented. Only physical commodities could provide true portfolio insurance against this level of systemic risk. As silver prices consolidated above $84 per ounce in the days following the operation, market participants were beginning to recognize that they were witnessing not just a temporary crisis premium, but a permanent repricing of physical assets relative to financial claims. The $100 billion Venezuelan oil heist had fundamentally altered the relationship between military power and economic value, creating a new hierarchy where physical resources dominated paper promises. The implications extended beyond precious metals into all commodity markets. Agricultural products, base metals, energy resources, anything that couldn't be printed or digitally created suddenly carried additional value as insurance against a world where military force could instantly reshape ownership structures. Silver's unique combination of monetary heritage and industrial necessity positioned it at the center of this transformation. The broader geopolitical implications were still unfolding as global powers adjusted to America's demonstration of resource nationalism. China's $60 billion loss in Venezuelan investments had created immediate tensions, but the long-term implications were more significant. If the United States was willing to use military force to secure energy resources, Beijing would need to reconsider its entire approach to international commerce and investment. This great power competition for resources created additional demand for precious metals as nations sought to reduce their dependence on potentially hostile suppliers. Silver's role as both a monetary metal and industrial necessity made it particularly attractive for countries building strategic reserves. The metal represented not just wealth preservation, but economic security in an uncertain world. The transformation was complete. Silver had evolved from a simple industrial commodity to the ultimate crisis currency, the one asset that could provide protection against financial collapse, supply chain disruption, and geopolitical chaos simultaneously. The $100 billion Venezuelan oil heist had created this transformation, but the underlying forces driving it would persist long after the immediate crisis passed. As global markets adapted to this new reality, silver's position at 84 per ounce appeared not as a peak, but as a new foundation for further appreciation. The metal had proven its value as the ultimate hedge against systematic risk, and that value would only increase as resource nationalism spread throughout the global economy. The age of paper promises was ending. The age of hard assets had begun.